Joining us now is economist from Market Economics, Stephen Koukoulas. Stephen, thank you for your time. All eyes are on oil prices this morning after this attack on the Saudi oil refinery. What kind of impact have we seen?
Yeah, the oil price was obviously responding to that disruption to global supply, or the Saudi supply, which is roughly 5% of total global output. So prices jumped somewhere between 10 and 20%. Of course, it's very fickle, it's very volatile right now, depending on updated news on the supply side and what's going to happen. But clearly, it's big. Had a small negative influence on US stocks. They only fell about 0.5% overnight. So an oil shock today isn't quite as powerful as it was in previous oil shocks. So for now, it's a contained issue. It's relatively small in terms of its impact on the real economy, but of course it's something that we're worrying. And rather than the oil price, it's what extent it actually spills over into geopolitical risks. Is there going to be some sort of increase in conflict, if you like, in the region based on this?
Is there a risk that this impact won't be felt for some time? Because we know the US did release their own oil reserves, but that's going to have an impact on their storage capacity.
It is, and it's going to keep prices relatively low. And of course, it keeps the supply going. You know, oil is still an important part of the global economy, obviously. It's still an important part. But compared to the mid-70s oil shock, when I was studying those things all those years ago, we've moved on. The global economy is now increasingly services-based. And we are still, to some extent, moving towards renewables. So while oil is important, it's less important than it was. So there are other producers other than the Saudis too. They can turn on their taps a little more rapidly, if you like. So there could be other producers taking advantage of this spike in prices too. So in terms of total dislocation, disruption, at the moment, it's a small issue, but as I mentioned, we're going to be watching it very closely.
And it is interesting to see what impact it will have on Australia's market in particular, because it seems like we are a bit protected just globally, given our geographic location.
We are, and that's a good thing, although we are heavily reliant on oil imports, and of course, I think roughly a third of them do come through the Middle East, if nothing else. So there is an impact here, and of course, we will be facing some impact on prices when these prices do flow through to the consumers and, of course, businesses that use oil. There will be an impact, but one thing that I noted yesterday, that even with the spike in prices in the last 24 hours, they're back to where they were in July. So oil prices are one of these markets that are incredibly volatile. They get pushed and pulled by these sorts of events, plus global demand. So the shock at the moment is, as I mentioned before, relatively contained.
Now, when it comes to local markets, housing in particular has seen a real uptake in the last 2 months.
Oh, it's been very strong. Look, I'm surprised about how powerful it's been, but if we think back to the period in May, obviously the election and negative gearing being an issue, and we know the election results, so negative gearing is unchanged. That's seen investors come back into the market. We've had 2 rate cuts in June and July. We've had an easing of credit restrictions. So there's a lot of positives that have all come into play at the same time. So we're seeing auction clearance rates move to, well, quite high levels. And if we look at the core logic daily and monthly house price data, prices are up about 3% in the last 3 months. That's a pretty decent sort of rebound in such a short period of time.
Especially this is a time of year that's not traditionally known for house sales.
Indeed, we're just starting the spring selling season and buying season, of course, right now. So it's going to be interesting to see how that extra supply, the spring selling season sees sellers put their properties on the market. And one slight concern, I guess, over the last couple of months of data is that it hasn't been on high volumes. There's not been a lot of properties that have been on the market, and that may be artificially inflating these price numbers that we've been seeing. So, as you mentioned, the real test is now, over the next few months, as instead of a few hundred properties are sold each week in Sydney and Melbourne, it'll be up towards 1,000, perhaps a little bit more. Will their buyers still be sufficiently strong to keep this price increase continuing?
And we're waiting for the budget outcome for 18-19 to be announced. What do you reckon? Are we going to see a surplus?
Oh, if I was Josh Frydenberg, I'd just deliver a dollar surplus, or just a tiny surplus. One of the things that is the mystery in this period from the end of the financial year until the final budget outcome is announced is that one of them is the RBA dividend. The RBA, when it's got profitability, does pay the government a couple of $2 billion per annum. And if we think about what the RBA's holdings of foreign exchange has actually done over the last 12 months, its profitability, the Aussie dollar's fallen. That is actually beneficial to the RBA because it's holding US dollars and yen, and as the Aussie dollar falls, they get more money. The bond market yields have fallen, which actually means they're making more money from their bond holdings. So I suspect that one of the items that will help Mr Frydenberg come out in the next week or so and say, here's a tiny surplus for 2018-19, is an RBA dividend, which will give them that extra couple of $1 billion to just put them into the plus side.
How much of that is just iron ore prices going well as opposed to good economic management?
A lot of it's the iron ore price, yes. Here we are today even, and the iron ore price is back at $99 a tonne. It did drop to $80 a week or two ago, back at 99, and that's just free money. The budget assumptions have been around $55 a tonne. So here we are in the 80s to 90s towards $100 a tonne. The sensitivity analysis in the budget papers shows that for every $10 a tonne on iron ore, they get $4 billion per annum. So here we are, $20, $30, $40 above the budget assumption. There's $6 to $8 billion just from the iron ore price.
And I guess there's a political advantage to them eking out into a surplus, even if it's less, because they had that criticism at the last budget where they were saying they were in surplus when they weren't yet.
And here it is, and the momentum in for fiscal year 2019-20, the one that we're roughly a quarter of the way through now, the surplus looks ashore there. So whether it's just a tiny wafer-thin surplus in 2018-19, we'll find out shortly. But importantly, if they can lock in the 19-20 surplus, then politically, we won't talk about economics yet, but politically, they can go to the next election saying we've delivered 2 budget surpluses, and the powerful impact of that on the electorate will be quite notable.